Hello, everyone. Greetings from the channel, Autodidact. We are back in continuation of Module 1 for Section 2 of the course Stock Market Investment, a complete course to make from a naive to an expert. In the previous section, you were introduced to the different market terminologies used in the stock market. Let's try to stitch these narratives together and understand how the stock market works. We will initiate the flow of stock market functioning with stock market working sequence. After this, we will get acquainted with the parties involved in the stock market for executing your orders. Lastly, we will gain knowledge about how your order is processed. Firstly, moving with the flow, a company gets listed in the primary market through an initial public offering (IPO). In its offer document, it lists details about the company, the stocks being issued, and so on. During the listing, the stocks issued in the primary market are allotted to investors who have bid for the same. This trading is done on the stock exchange, which is a secondary market. For doing trading, brokers are a medium of connecting you and the stock market. He usually takes the order and passes the order to the stock exchanges. The stock market then searches for a similar order and executes it. When the order is executed, it is credited in the DMAT account in the next 2 working days. Moving ahead, we should now be understanding about various participants of the stock market in the sequence of their role. So, there are 4 participants in total. Firstly, it is a stock exchange, which is a platform where financial instruments like stocks and derivatives are traded. Market participants have to be registered with the stock exchange and SEBI to conduct trades. This includes companies issuing shares, brokers conducting the trades, as well as traders and investors. All of this is regulated by the Securities and Exchange Board of India (SEBI), which makes the rules of conduct. These stock exchanges enable the investors or the traders to participate in the stock market. The second participant is the investor himself. This is the sole task of the investor, that is to gain insights of a particular investment or a stock. The person needs to do savings to make these investments. Saving is the money left from the income after incurring all the expenditures. After doing his own research, he picks up the stock to put his money. Furthermore, he contacts his broker for placing his order. He can place the order either through online mode, like various trading platforms are available, or he can contact through phone or whatsoever is convenient for them. Soon after receiving the order from the investors, the broker forwards this request to the stock exchange. The role of a broker or a broker firm is to take the orders from the investors and pass it on to the stock exchange. Basically, it acts as the interconnection between the investor and the stock exchange. Then it is a stock exchange task to execute the order. The stock exchange matches the bid price from the sale price, e.g. if you are willing to buy Infosys at ₹1,200. There will be hundreds and thousands of sellers willing to send it more than ₹1,200. Then, the exchange will look for sellers who are willing to sell at ₹1,200. Otherwise, the order will be kept open unless the seller comes to accept that price. As soon the trade is executed, it is confirmed to the broker. The broker charges a fee or commission on every executed transaction. In the backdrop, the crucial role that is played by SEBI, the Securities and Exchange Board of India. The role and functions of SEBI includes protecting the interest of each participant of the stock market. It takes charge of monitoring, controlling and regulating all the security-related functionaries. For more knowledge about SEBI, please refer to the relevant video from your own channel Autodidact. Now the last and main part is about the processing of your order. The process includes 5 stages, initiating the moment when you place the order, either to buy a security or to sell it. Investors to place their order for buying and selling the stocks. Their decision is completely dependent on their own anticipation. Though, the assistance can be taken from market advisors, experts and news. Generally, the buying order comes when the investor feels that the market will go up. Similarly, the selling order is placed when the investor feels that the market will go down, and he should book the profit. Your broker passes on your buy order to the exchange, which searches for a sell order for the same share. Even at the broker and exchange levels, there are multiple parties involved in the communication chain like brokerage order department, exchange floor traders, and so on. However, the trading process has become electronic today. This process of matching buyers and sellers is done through computers. As a result, the process is finished within minutes. While executing the order at a stock exchange, there are multiple parties involved in the process behind the scenes. Meanwhile, the exchange also confirms the details of the buyers and the sellers to ensure the parties don't default. Exchange matches the buying and selling orders with zero spread. It then facilitates the actual transfer of ownership of shares. This process is called settlement. Earlier, it used to take weeks to settle trades. Now, this has been brought down to T+2 days. For example, if you conducted a trade today, you will get your shares deposited in your DMAT account by the day after tomorrow, that is 2 working days. Once a seller and a buyer are fixed, a price is agreed and finalized, upon which the exchange communicates to your broker that your order has been confirmed. This message is then passed on to you. Haircut is changing the price so as to match the counter price. Means like, if you are willing to buy a stock at rupees 299.70 and seller is demanding rupees 299.90, so you can increase the bid price by 20 paise to let the stock exchange execute the order. Once it is done, the confirmation is sent to the broker immediately. Then to the investor is also conveyed at the end of the day. As and when trades are conducted, share prices change. This is because prices of shares, like any other goods, are dependent on the perceived value. This is reflected in the rise or fall of demand for the stock. As demand for the stock increases, there are more buy orders. This leads to an increase in the price of the stock. So when you see the price of a stock rise, even if it is marginal, it means that someone or many placed buy order S for the stock. Larger the volume of trade, greater the fluctuation in the stock's price. And the last stage can be seen as the debit or credit from the dematerialized account of the investor. After the execution of the trade and subsequent confirmation to the broker credits the purchased stocks in the dematerialized account of the investor or debits the sold stocks from the dematerialized account of the investor. With this step, the process of order handling is completed. We will now have a very short quiz. So friends, this is all for now. If you have any other topic to be included, please mention in the comment section. I will be back with another section of your learning soon. Please subscribe to the channel to get regular updates. Don't forget to like and share the video. Till then, stay healthy and happy. Till then, all the best.